So the next panel is about where is private credit working best. And we have 4 very knowledgeable people here who are going to introduce themselves and tell you what they do and what their fund does. So Stephanie, if you want to start introducing yourself.
Hello, everyone. Can you hear me? Yeah, no problem. Thanks for being here today. So I'm Stephanie Heller. I'm the co-founder and managing partner of Bootstrap Europe. We're a private credit fund that is active in the very early stage of the spectrum. We're a venture debt and growth debt fund. So we do finance everyday technology businesses that are growing and that are very innovative.
Great. Simone?
Hi, can you hear me? Does it work?
The audience, can you hear?
Okay.
No.
Right.
Okay, Simone Tedeschi, partner at Apis, and we are a growth private equity firm specializing entirely in financial service and technology. We have a global realm. We love the UK. We've been very active in this space with investment in Moneybox, among many. And we are looking a way to serve our portfolio companies, our target companies, by expanding our product range with opportunistic credit and alternative non-dilutive solutions.
Great, thank you. Warren?
Hi, Warren Brockway from Westbrooke Alternative Asset Management. We're a UK-focused alternative asset manager. I head up our corporate lending business, which is effectively a direct lender as well as a hybrid capital solution provider. We focus on the UK lower mid-market, supporting both sponsor-backed businesses as well as founder-managed entities. We support both growth opportunities as well as acquisitions and look to ultimately structure unique solutions to help drive that growth in that lower mid-market.
Thank you, Oliver.
Hi, I'm Oliver Baker. I'm a senior investment leader at Partners Group. So Partners Group is a Swiss-headquartered but global private markets asset manager. We're managing about 175 billion of AUM. 35 billion of that is in private credit. I sit within the direct lending team in Europe. So we are providing loans to middle market companies, usually private equity backed, both senior and junior capital, usually for LBOs, for M&A and recapitalizations.
Thank you very much. So because we want to see where private credit is going to evolve, we know that so far, a bit like Blair said, where is private credit where did it come from? It used to invest in the most plain vanilla, like non-cyclical, cash-rich companies, sectors, tech, health, and so on. And my question is there an evolution there? We start seeing things like maybe defense or some more kind of sectors that used to be no for private credit sector. So I just wanted to have your opinion, guys. Where do you see these sectors now? Oliver, maybe you want to start off?
Yeah, sure. Well, there's obviously been a lot of growth in the private credit markets over the last few years. Some of that is coming from a broadening of investment strategies. So you now see everything from venture debt right the way through to sort of jumbo billion-dollar plus financing. Even Meta is out there raising money for its data centers from private credit shops now. Partners Group are really focused on the mid-market. We see a sort of Goldilocks zone of companies between 10 and 50 million of EBITDA. We think those companies don't have good access to capital elsewhere. They can't access the syndicated markets. They can't access the public markets. They're not particularly well served by banks either. So if you're a mid-market company, you want to raise 200 million of financing, you can go and put 4 or 5 banks together, or you can come to a bilateral, agreement with a lender who can scale with your business, be more flexible, but also, is going to charge you a bit of a premium for that. In terms of sectors, like you say, healthcare, technology, professional services, the usual suspects still make up a bulk of the market, something like 2/3 of the market across those sectors. But we see a lot of activity as well in industrials, in financial services. for us at Partners Group, where we've deployed, a lot of capital is into industries where there is some sort of buy and build or consolidation happening. So fragmented industries that are often being affected by, increases in regulation, causing increasing compliance costs, forcing sort of a combination of smaller businesses, also technological adoption. A lot of businesses are grappling with that nowadays. The need to invest, is the capital available? There's more benefits of scale. So, in the UK, wealth management is a good example. There's probably 40 different private equity-backed consolidators in that market now. Most of that is supported by private credit. Accountancy is another good one. It's a very good time to be a partner at a small accounting firm at the moment. There's huge demand for those types of assets by the consolidators. And again, private credit is really active in supporting that sort of buy and build. Yeah.
Great. What would you say? Is there like a trend phenomenon? People just follow each other, or is there a real business case?
I think there's a bit of both,
Yeah.
right? Obviously, if business owners see attractive multiples being generated in the sector, it can prompt them to bring an asset to market. But as I say, I think there are also fundamental drivers in those sectors, right? Increasing regulation, investing in technology, particularly for the accounting firms, there's staff shortages, they need to invest, become more efficient. And if you're a small firm with a few partners, you maybe don't want to do that yourself. So it can make sense to join a bigger platform.
Fair point.
Yeah.
Stephanie, I think you invest a lot in tech, no?
No, absolutely. So, we are at the forefront of what's next and what's happening, every day. So in terms of, let's say, the sectors of, new sectors that we see are demanding more capital, obviously with the pressure, I guess, on energy independence throughout Europe and also UK, you see more climate technology businesses being funded. So there is a lot of deal flow coming from that side of the world. The other big trend, and you mentioned that, is anything touching defense. But when you're thinking of defense, you're also thinking about strategic technology. So obviously data centers, anything touching semiconductors, anything touching specialty material, electrification. So drive, we have a few companies in the UK in the, original belt of let's say, the car industry that are, inventing new electric motors, for instance. So you're seeing this sort of deals coming into, the lenders, because they've been cooking from the venture capital for a few years and now are transitioning to us. So it's very exciting also in terms of exposure and diversification, I think, for us.
Great. Simone, do you have anything to add on the subject, or?
We're obviously very excited by the adoption of debt solution by tech-enabled mid-market financial services across Europe and globally. Typically, what we see is a couple of things. First of all, SMEs in our space are quite data rich, and they embrace technology and risk management intensively. We do see also an interesting trend, the adoption more broadly of the term financial infrastructure, meaning our industry historically has been relegated to be hyper-growth, VC style fintech. The reality is people have understood that financial infrastructure has the criteria, meets the requirement of many infrastructure type of investments. For instance, Brookfield recently acquired the merchant acquisition business from Barclays using an infrastructure fund. And so this effectively borrows our industry also to credit solutions that typically were associated with infrastructure. These are the two things, technology and adoption of infrastructure as a term and as a culture.
Thank you. Warren, you want to say something?
Yeah, I think when we think about sort of the evolution of different industries, and I think when we think back of where private credit has been focused and sort of from a debt-led perspective, it's always been industries that are, essential services. And I think that just naturally evolves with time. Roll back 5-10 years, military spend probably wasn't seen as essential services. Roll forward to today, you can see an evolution whereby, I don't think it's necessarily something more fundamental in our view than actually that's just an evolution of the economy, evolution of society, where that becomes a new sort of essential service. You could see that becoming a potential play, and I think that's just how then new industries come into sort of flavor within sort of the private credit market.
Thank you. Warren, I want to stay with you for my next question. We're talking about evolution, and there's also evolution in fund structure. Private credit was born as a closed-ended fund kind of type business, and it's completely evolving towards evergreen and more particularly private wealth. What can you say about this evolution?
I think we are a closed-ended fund, but what we have seen is a lot more talk and interest in these evergreen funds. And I think you touch on it. A lot of interest is coming from the private wealth space. I think that's a function of a broadening and more sophisticated investor globally. And I think just as a society again evolves, people like the ability to know that they're in these evergreen funds have an ability to access liquidity, trade in and out. I think a lot of it becomes sticky capital in any event, and ultimately your investor base, buys into the strategy, buys into the fundamentals of alternative and sort of private credit. But the ability to be able to move in and out like consumers like, which are sort of private wealth investors are, that then creates a new base for us to sort of tap into an investor base beyond sort of the typical pension fund institutional type investor. And I do think we're going to see a bit more evolution of that across our space.
Okay, thank you. Oliver, I see you nodding.
Yeah. I think it's a super exciting, part of the industry at the moment, this sort of private wealth, democratization of private markets, this idea that, retail and high net worth should have access to the same sort of investment content as institutions. I mean, evergreens is a hot topic now because I think they're a good way to address that demand. They're not new, right? They've been around for a long time. I think Partners Group, first launched an evergreen in 2001. It's about a third of our capital is actually raised in those evergreen programs. But for private wealth, the fact you don't have capital calls, J curves, your capital's not locked up. It's a good solution for that, and the size of the opportunity is ginormous, right? There's 140, 150 trillion of private wealth assets globally. Only 1% or so is currently allocated to private markets. So if that was to get anywhere close to the 10, 15, 20% type allocations that you tend to see from institutions, you can see that there's a big opportunity there.
Fantastic. Stephanie, do you have an opinion on this?
I would love to comment on this because I think there's two drivers to the evergreen trends. Is one, on one side, you have, with private credit, an asset class that is so, let's say, broad in terms of its revenue. So it has yield, it has increase in NAVs as well, and so you can structure it beautifully. You can structure it as more liquidity for your LPs, etc. And the other driver of this is obviously if you take your asset manager's hat and you can pull that structure together, it increases the valuation of your asset management company. And if you run the calculation for us, it would be at least 30% because your valuation is based on your future cash flows. So there is really two things driving it. It's in the advantage of the GPs, and the LPs are demanding it. So first, we have synthetic evergreens that were asked by some LPs. We've set them up because obviously they like the idea of recycling the cash from one generation of funds to another generation of funds. So there is also the demand from the LPs that's very, very strong for this sort of structure.
Simone, you have got more of a private equity kind of angle. Is that similar for you? Or?
Absolutely. First of all, not much to add on the appetite that we all have to access private wealth. What I do notice, however, is another big trend, which is SMA, separately managed account, customization to specific LPs. especially in private credit and especially in our sector. Customization means customization of requirements. We spent a lot of time with a specific LP, I would say MABs, in defining the investment criteria. This allows us, first of all, to, I would say, allows the LP to focus on our industry vertical, for financial service and technology, geographical focus, maturity, duration, coupon, minimum investment return, and potentially upside, non-upside, diversification. We had a conversation early on, and we are surprised how scalable that is. To be clear, SMAs right now are 3.6 trillion of the market, so it's nothing new. But what I find new is the level of LP engagement in the definition of those investment criteria, and we love it. And we're learning a lot from that dialogue.
Fantastic. So we had a senior government minister earlier, and Blair also talked about how private credit has a role in the economy altogether. So that's kind of a question I would like to ask. What's the role of private credit in supporting innovation, sustainability, and even regional development? Maybe Stephanie, you have an opinion on that?
Well, obviously, any capital, flowing through, any sectors or region is, a way to create real businesses, employment, etc. So that, is one thing. For us, what we see in terms of the, startup scene is with the wave of AI, companies are being built anywhere, right? In terms of the, let's say, UK regional split, it doesn't need to be in London. And so, for those sort of, let's say, opportunities, it means that some of that money is flowing into, leads, etc. In terms of Europe, because we're European investors, we tend to go and find the innovation where it's born. So if you look at the last investment we've done in InsurTech, obviously it would be Frankfurt in Germany. We've done 2 companies in semiconductors in France, both exited last year. They both happen to be on Sophia Antipolis and Grenoble, which are the, let's say, Silicon Valley of France, like for semiconductor. If you do an investment, for instance, in optics, you're going to be investing in some of the region in France. If you do investments in electric motor, I was mentioning this, you'll be around, Cambridge, Norwich, etc. So there is really an idea that if you want to find the best opportunities, you have to go where the knowledge is, next to the universities where they're building the people. So in what we do every day in supporting innovation is really much interlinked.
Oliver, do you think private credit can develop regions and?
Yeah, well, I think it's a pretty complicated operating environment out there at the minute, right? The sort of geopolitical aspects, the technological disruption. There's a lot going on for businesses to deal with, and what you tend to see in those times of more complexity or more volatility is that private credit actually steps up to the plate and tends to take more market share. And Blair alluded to this earlier. There's more consistency in terms of appetite to deploy, typically from the direct lending community. Can price the risk, whereas traditional sources of finance, sometimes just take a step back from the market and are less willing to provide capital. I think the other thing private credit lenders can do to support businesses is to provide flexibility in terms of how those loans are structured, right? So with interest rates going up over the last couple of years, we've seen an increase in the ability to pick part of that interest, to allow the business to retain and reinvest more of its cash flow. You might also have ability to re-lever the business in the future, putting in place portable financings. So the M&A market has obviously been a bit quieter over the last year or so, but companies are putting in place financing that will allow them to take their business to market with the financing already in place and port it across to a new owner. So I think there are things that private credit lenders can do to support businesses that perhaps traditional sources of finance can't.
It's true, and the macro level might be chaotic. Maybe we should look downwards towards more like regional and at the micro level. Warren, you're nodding. What do you think about now?
You know, as a UK low mid market business, a lot of the time and energy we spend is out of the regions. Obviously, we sit in the M25. There's a lot of business here, but bulk of sort of the services and businesses that are really servicing most of the UK economy is sort of across the UK. And I think Oliver touched on it. Is if you look back over the last year, one of the things we've seen is there's been a retreat from equity providers, growth equity providers, and private credit has been able to sort of step into that. And we've seen through our hybrid capital offering, being able to sort of be an alternative to the equity solutions and growth equity solutions, being able to support those businesses that are, quite frankly, growing and needing some capital to grow, but given a bit of a dislocation between valuations, founder-led businesses sort of wanting to take it to the next level, private credit creates that that flexibility and optionality to have a different solution on the table, which then continues to drive the growth which quite frankly the economy needs. And then sort of as the Chancellor was saying, back in those builders. Well, we are builders, but those builders are sitting outside in the regions.
Simone, is it the same for you?
Absolutely. Building a warrant argument. I mean, 60% of SME lending in the UK is done by alternative credit offer and challenger bank. All I can say is our industry is key in that. We are looking to back tech-enabled SME lender in the UK with a very broad distribution of the product across the region, and candidly, we don't distinguish the region. I mean, we simply look at the financial parameters and they seem all fine. So I think the industry is already playing a significant role.
Thank you. We only have 1 minute, so I'm going to ask you a question you're all going to answer. So what investors and borrowers should know about navigating this fast-evolving landscape? So maybe, Simone, you can start. A tip.
Learn about new industries that are not historically associated with private credit. Unsurprisingly, one of them is financial service and technology.
Warren?
I think it's touching back on the flexibility, being able to sort of adapt both sort of, in sectors, in situations, and in structuring, so be able to get things done.
Thank you. Oliver?
Yeah, look, I think it's a very exciting time. The market has been pretty well stress tested, not only if you go back 10, 15 years, but more recently with COVID, inflation, higher interest rates, and default rates haven't really gone up too much. So I think, private credit seems to be here to stay. There's loads of new types of strategies coming online, NAV financing. There's the secondaries market, which is really nascent, but could become massive, like the private equity secondaries. Yeah. So I think there's a lot to look forward to.
Yeah. Stephanie?
So for me, it would be, really around innovation and working with specialist teams. I think there is a big opportunity in private credit at the moment to work with specialist lenders that, just focus on one part of the market, but have the expertise to recuperate assets, to find collateral that others won't.
Perfect. Thank you very much, everyone.
Yeah.
And please join me in thanking the very insightful panel.